You've been looking to start investing in Canada and don't know how? This is the video for you. I'll be going over the basics on what you need to know before starting. As always, this video is for information and entertainment purposes only. This is not financial advice, and you should consult with a professional and do your own due diligence before making any decisions. Alright, let's get started. The first thing you should do before investing in anything is pay off all your debts. This could include credit card debt or student loans. Once that is taken care of, you should budget and track your expenses to determine how much you can save from your monthly and weekly income. If you're having trouble saving money, it can usually be categorized under either an earning or a spending problem. If it's a spending problem, then it's pretty straightforward and you should aim to stop spending on unnecessary things like designer clothes or eating out all the time. However, if it's an earning problem, then it may be a bit harder since you may not be able to just magically start earning more. A few suggestions would be to start working a part-time job on the weekends, finding a different career that pays more, or starting a side hustle like Amazon FBA, flipping sneakers, or freelancing to acquire some additional income. Once you've identified that you have some money you can save, the next step is to start building your emergency fund, just in case of any unexpected problems that may occur in the future. A general rule of thumb is to have around 3 to 6 months of expenses saved, and I recommend using the EQ high interest savings account for this, as you can also earn around 1.5% interest on your savings without the potential of losing it in riskier investments. After you've built up that emergency fund, the next step is to find a broker like Scotiabank, Wealthsimple, or Questrade to open an account where you can buy assets. I would recommend Wealthsimple as they have zero commissions when buying Canadian securities. I will make a video in the future on which one may be the best, but for the beginner, you can't go wrong with Wealthsimple. Now that you have a broker, you need to open an account inside the broker. I want you to think of a grocery store and how you start by grabbing a basket or cart to put your groceries in. This basket or cart is your account and is usually called a TFSA or RRSP. Here, you need to actually shop and buy different things like apples or oranges, otherwise called assets. These assets can take the form of index funds, bonds, or individual stocks like Facebook. The TFSA or tax-free savings account is an account where all money earned in it is tax-free and the CRA cannot touch any of it as long as you don't go over your contribution limit, which gets established every year on the CRA website. The RRSP or registered retirement savings account, on the other hand, is a tax-deferred account where you can deposit money into it to lower your income so you pay less income tax. But when you withdraw this money, you will be taxed on it and a portion of it will go to the CRA. A general rule of thumb is to max out your TFSA first, but if you're raking in a lot of money, a RRSP might be a better option. Now that you have your brokerage and account set up, we can get to the fun part, picking your investments. There are many areas where you can invest in, but it's best to think about what you're looking for and your risk tolerance. I have broken them down into 4 types here based on the risk and difficulty. The first being bonds and GICs, or guaranteed investment certificates. This would be the least risky as the chance of you losing your money here would involve an entire country or corporation to collapse. Basically, this is where you lend money to a corporation or the government and they pay you a small percentage of interest for your loan. The rates for these are quite low at around 1.2% last time I checked, and they're usually fixed on duration, so you can't pull out your money anytime. If you do, you may be penalized since you pulled out earlier than the maturity date. The next asset would be what I would recommend for most people, and they are index funds or ETFs. These are generally quite safe if you have a very long-term investing horizon and are exponentially better than bonds or GICs. An index fund or ETF is a type of security that tracks a component of the financial sector like the S&P 500 or the Dow Jones. The S&P 500 is the most popular one and what people usually are talking about when they refer to the market. A fund like VFV for Canadians or VOO for Americans would be a great way to invest in it. However, there are many other index funds like VUN or VTI that track the total stock market, or QQC.F and QQQ, which track the NASDAQ. But for simplicity's sake, we're only going to be talking about the S&P 500 in this video. The S&P 500 essentially tracks the largest 500 companies in the US like Amazon, Facebook, or Apple. It has had an average annual return of 10% since it started in 1926, so it has been quite stable if you're in it for the long term. Keep in mind this is an average annual return, so it may fluctuate between 7% one year, negative 7% one year, and positive 20% the next. Investing in the S&P can certainly make you a millionaire if you're patient and consistent with it. If you just Google a compound interest calculator or future value calculator online and punch in the numbers, you can see that if you just put $300 into the S&P 500 every month for 35 years, you will have accumulated over $1 million. Of course, if you contribute more like $500 a month, you can reach that same milestone in 30 years. This is why it's so important to start investing early, as having time on your side not only mitigates risk, but gives your money the chance to compound more and more. Now, moving on to individual stocks where it gets riskier, but the rewards or returns you may get could be exponentially better. If you go back to that compound interest calculator and still deposited $500 every month, but your annual average return rate was 20% from picking these individual stocks, you would be a millionaire in just 12 years. Examples of individual stocks would be Apple or Facebook, which can also be bought in your TFSA or RRSP, just like index funds or bonds can. However, you should do a lot of research and analysis about the business before you put your money into it. Learning terms like PE ratio or being able to read the balance sheet and income statement are fundamental before you invest in individual stocks. Lastly, the final area of investment you can do is in real estate. Now, I'd say this would be the same risk level as individual stocks, but with the work and initial capital needed to get into this, it's a lot higher, and depending on what you want to do. There are many ways you can do real estate. You can wholesale, flip, or rent out different real estate properties, all of which can make you money. I would recommend doing more research about all of them and your local real estate market before getting into this. That being said, an easier way to get into real estate without all the work would be investing into a REIT, or a real estate investment trust. This is where you essentially invest into a company that buys real estate, and the money they make from their operations is usually paid out to you in dividends. You can buy these REITs in a TFSA or RRSP account, the same place where you buy your index funds, stocks, or bonds. If this interests you, one REIT that I think may be worth looking into is REITcan, or REI.UN. That being said, I hope you learned something in this video and will put it into action. Links to all the platforms I mentioned and other resources will be in the description below. Please remember to like the video and subscribe for the YouTube algorithm. I'll see you in the next one.